Hi everyone, it's Arry here, Arry Yu, Chair of the Cascadia Blockchain Council, and also your host for these weekly AMAs with the Blockchain Underground. Really happy that you were able to join us, or if you didn't, really happy that you're checking this out because this recording is for you. Remember, we have a weekly AMA every Friday from 12 to 1 p.m. PST. Just sign up on the Blockchain Underground under Meetup. And sometimes we have community events where we just chat and get to know each other because relationships are really important. And then sometimes we have guest speakers like this one with Jennifer Mace from Clark Nuber. And she answered all kinds of questions and even gave a presentation about some crypto tax updates. So it was really interesting. Hope you learned as much as I did. And if you have any questions or need any support or have any ideas on what we can do to better support you, please do message me anytime. You can find me on Twitter or on Slack. We have a community group there, or email me anytime. Hope you are having a great day and enjoy the show. Thank you. Let's kick off with introduction of Jennifer Mace. Jennifer, can you give us a longer 5-minute background of yourself? How did you get into crypto? I don't know, just your background in understanding taxes and Clark Nuber.
Yeah, sure. So I'll just kind of start with my professional background. So I'm a tax shareholder at Clark Nuber. I've been at Clark Nuber now for just about 14 years. And before that, I was with KPMG in their international tax group. So I kind of started my career in international. I still do a significant amount of international tax work for Clark Nuber. But I also spend a fair amount of time with our blockchain and cryptocurrency type clients. And I say type clients because there's a huge variety as far as clients that are, miners versus investors versus creating their own blockchains, or kind of anything in between, or not-for-profits accepting cryptocurrency as a donation form, or kind of any of those items. So I've spent quite a bit of time in that space in the last few years, especially. Clark Nuber as a whole is about 200 any given day, 220 to 230 total professionals. We have a multi-service organization, so we do not only tax work, but also the audit, assurance, and accounting services for a wide variety of clients. About 30% of our practice is actually with not-for-profits, not my practice, but our practice as a whole, and otherwise we kind of specialize in couple of different areas of tax, but also assurance services as well as technology for SOC 1, SOC 2 audits. And then for my cryptocurrency perspective, I came into cryptocurrency as a result of selling my house and having a little more risk tolerance than your typical accountant, I would say. Accountants, in my experience in the last few years, have not been super receptive to cryptocurrency. So when I sold my house, I had, some funds, and there was nothing on the market. So we said, okay, well, let's just see what we can do for a couple of years. And my husband got totally into it, and still is. But that kind of gave us the let's just see what all this does and what it means. And so we put some time and energy and investment into it, and it's been a unique experience. But it also kind of accelerated my understanding and learning, because as a tax person, I know I have to account for all of this on my own tax return. So that kind of got us all started. And then I've spent quite a bit of time with the AICPA and different governing assistance bodies to try and make sure that we have a good understanding of how the tax rules are going to work for the ever-evolving space. What the IRS has as far as guidance at the moment is so much slower than what's actually being created, and the guidance just can't keep up with how cryptocurrency is evolving and how quickly it's evolving. So we'll talk a little bit about that today.
Awesome. Very, very extensive background, personal and professional. It's going to be awesome. I know you prepared a presentation for us, which is really, really helpful, especially for those that are visual like myself. So let's get into the presentation, and then we'll spend the last like half hour or more with an AMA and let the community ask questions. And the way we do questions for everybody that's hopping on the call, and I'll remind people in the chat, you can ask your questions in the chat, and I'll try and grab them and ask Jennifer if you don't want to get onto the mic and ask live. Or you can just raise your hand, which is at the bottom window under reactions. You can click raise hand, and it'll put the raise hand function in the top of your window, and then I'll call on you when it's when I can grab you for a question, and then you can ask your question live to Jennifer.
Yeah, and I'll try and keep my eye on the chat as well. So at least we can grab the questions as we're going. Perfect. All right, so some of this that I'm starting out with is probably, you all already know all of this because you are in the cryptocurrency space. And I am going to focus more so on cryptocurrency than just blockchain in general. So this is kind of specific to cryptocurrency. So let's go ahead and let's see here. I think I just need to do this. There we go. Okay, so just as kind of a history, as you all probably know, Bitcoin in general was intended to be a peer-to-peer electronic cash system, which interestingly, some countries have had a similar system in place for a long, long time. However, it's privately run and there's no decentralized nature to it. So in this case with Bitcoin or any number of different currencies that we have out there at this point, the intention is to be primarily decentralized. There's also centralized networks as well, but that's kind of what we're talking about mostly today. It's interesting. So last year in 2020 in June, we had the AICPA blockchain symposium. And at the time, the count of cryptocurrencies was about 7,000, which was still a huge jump from the prior year. Well, we had that same conference in, I think it was July of 2021 this year, and now there's over 10,000 different cryptocurrencies. So it kind of gives you an idea of the exponential growth of this. And I was actually listening to a presentation from one of the ARK Investments Capital Management about the pace of change in technology. And she kind of identified 3 key areas in finance, one of which was cryptocurrency and virtual currency. So she equates this to the birth of the internet, computers, and or even stepping further back from that, the last time there was multiple versions of this kind of exponential growth potential and change, back to the light bulb, electricity, all of and the internal combustion engine, all of those things that were created all at the same time just created a massive amount of growth all at once. So blockchain, AI, and I can't remember now the third one, but regardless, there are 3 of them that she feels like that's the same level of change that those kind of earlier instances really created. And you can see that from the growth and the evolution of how this space evolves and how quickly it evolves. NFTs, relatively new, but at the same time, that would have taken 20 years to develop on like a historical kind of track record of change and such. So it's very interesting how much more quickly the pace of change is going. And as you can imagine, our governing bodies don't move that quickly, right? So the IRS in particular has provided some guidance, but they don't necessarily know about all the stuff that's happening and can't issue guidance fast enough to kind of manage all of that. Okay. Okay, so I see a couple of questions. So NFT is a non-fungible token, is that right? I think that's but it's basically, I think you may have seen, for example, the very first tweet on Twitter was sold for, I think, 2 point something million, I think. I mean, yeah, kind of crazy amounts of money we're talking about. But it's kind of like monetizing, it's monetizing things that are electronic based. So historically, we've been able to sell tangible goods like art, but there are electronic versions of art that can be sold through this system. It's that's a very basic definition of it, but that's kind of the idea, at least. All right. Let's get to the next. All right, so from an IRS perspective, though, the guidance that we do have so far is that Bitcoin is not a currency, which is not necessarily a bad thing. In my personal opinion, it is considered property. So property gets the same treatment that stocks or something like that would receive, in that you can get short-term or long-term capital gains, which is very helpful to have if you're a trader and investor in that type of an asset. If it was currency, it's all ordinary income. So you're paying the highest level of tax at that point in time. So not necessarily a bad thing that it's not considered currency, at least from a tax perspective. Also some downsides to that, because with using currency, there's exceptions for like smaller transactions that would be exempt from reporting. That is not the case with cryptocurrency. So, some good and some bad with that. We received a couple of different versions of guidance. So in 2014, we received a IRS notice, basically, that gave us the fact that the IRS does think that it's property. And in 2019, we have a revenue ruling that provides slightly more guidance and more confusion. So we'll go through kind of some of what all of that actually looks like from a variety of different perspectives. But I think the key, at least the key takeaway in my mind for all of this, is that the IRS commissioner, Chuck Reddick, has basically said, if you get a letter and your name is on the letter and it's your home address on the letter, IRS has information regarding your cryptocurrency transactions, and you probably should comply. And this quote was back from, that was a couple of years ago. I think that was back in 2018, after the kind of, I'll say, first noticeable spike amongst the general public, maybe is the right way to say that. And so as a result of that, the last 2 years of tax filings have had a specific question on the 1040. Prior, it was in a supplemental schedule, so not a lot of people maybe knew it was even there. But now it's on the front page of your 1040. This is on the very first page of how you file your personal income tax return. And it asks, at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in virtual currency, right? So basically any transaction, for the most part, is going to need to be considered for purposes of that question. Now, this question doesn't mean, oh no, I have to pay tax or I have all of this extra reporting. It depends on what you did during the year. This is the same approach that the IRS took with foreign bank account reporting. It's to incentivize people under penalties of perjury that to comply willingly with the information, and that it actually brings it to the forefront, meaning maybe you didn't know you needed to put your capital gain or your transactions on your return as capital gain income or what have you. And now this at least makes you ask the question of, oh, does that mean I need to do something? So it's kind of a awareness, recognition, but it's also something to help kind of incentivize folks to maybe comply, because again, you're signing your tax filing under penalties of perjury that says, I think I did everything the way it needs to be done, and I reported all the stuff I'm supposed to, right? So with that level of scrutiny that is inevitably coming down the pike, we're going to talk about kind of two key areas here. The first is with federal income tax, and then the other is state and local. I'm going to spend 97% on federal income tax with a little bit of extra thrown in for the state and local treatment. I don't know where everyone's located kind of physically, but I'll talk a little bit about Washington State's new capital gains tax, and we can kind of talk through a little bit of that as well. So the first thing I want to talk about is mining. So when you mine cryptocurrency, the federal income tax treatment for that is it seems easy because it's ordinary income, self-employment income, to the extent it's a self-employment type activity. However, it's not as easy as that, because if you're, for example, part of a co-op of miners, and you are mining in very small increments to start with as an individual, but the co-op then doesn't pay out your share until, say, let's just pretend 2-3 weeks later. The value that you recognize on your tax filing as income, what value should you use? Should you use the value as of the date that you, as a co-op group, mined it? Or should you be using the date that you actually received it from the co-op, right? That can vary wildly, as you can imagine. If we're talking about Bitcoin and you mine, let's say, 1 Bitcoin 2 weeks ago versus today, I think it's like a $10,000 difference already. So, that's not a small sum of money when you're talking about what you have to report for your income tax filing. So that isn't known. That's not something that they've provided guidance on. It's basically when you have the right to it, which again isn't. It's kind of not necessarily the easiest thing to track, let alone actually understand how to go through that process. But what we do know is that it is considered ordinary income. It is subject to self-employment tax as your own business that you're operating. And you can expense items that contribute to the mining operation. So electricity costs are a sizable chunk of that expense, or computing power. So anything that that you use as a part of that business, you can actually expense and offset against the income. For state income tax purposes, it varies a little bit based on the states. In some cases, if you are a business that's mining, it's going to look at mine and management over where the servers are located, for example. But other states will look at where the servers are located, or the computers. So you have to be kind of careful on where you are physically located as an individual owner versus where you actually set up the mining equipment. So that's something that we've gone through with a number of clients and tried to figure, and also electricity costs, right? Because that makes it, you have to consider the actual business itself and make sure that you've got, in a place that makes financial sense as well. So those are kind of the things that we think about from a mining perspective. And then once you've mined the cryptocurrency assets, then you essentially become an investor, right? So as an investor in crypto, then you have a capital asset in your hand. And that means that to the extent you are to sell that asset, you would recognize capital gain or capital loss, as the case might be. You can have short-term capital gains, which would be anything held for a year or less, or long-term capital gains. And the benefit of long-term capital gains is a much lower tax rate potentially than your ordinary income rate. So instead of it being 37% at the highest rate, plus self-employment taxes and all that, it would be 23.8 maybe instead. Okay, so that's a nice. Okay, great question. 2 questions actually. So how are taxes calculated when the mining is occurring in another country? Should be the same. From a U.S. tax perspective, it should be the same as far as timing and type of property and all of that. The distinction is, one, is it held in a foreign corporation? And that's the foreign corporation is the one that's actually doing the mining. If that's the case, there's a whole slew of reporting requirements on an international basis that you are required to do from a U.S. perspective, particularly with disclosing the activities of the foreign entity. One foreign filing that's missed is a $10,000 penalty. So that carries a lot of weight. So you want to make sure if you are doing that on an international basis that you're accounting for all the disclosures that are required for how it's managed and mined and all that. If the other country also taxes it, then you would, in theory, get a credit for that so that you're not paying double tax. Theory. It depends on kind of how it all would end up working with the particular country, the treaty we have, and how it's actually set up. So there's a lot that goes into that, but we can, if you have questions on that specifically after, I'm happy to answer those. Genesis mining is so we'll see if I'm understanding what you mean by Genesis mining. So when a brand new blockchain is created, there's typically a Genesis event. And during the Genesis event, the initial kind of outlay of cryptocurrency, you can end up with a whole bunch of cryptocurrency to potentially the founders of the blockchain. I've seen multiple legal opinions that would argue that a Genesis event, if it's built into the code of the blockchain, is a non-taxable event to the founders. But it's very fact specific. So you would want to make sure that you understand for your particular blockchain how that would work. Okay. All right. So there used to be, well, I say used to be. So under the pre-2018 tax law change, there was a lot of talk about whether or not cryptocurrency was considered like kind and whether or not it qualified for a 1031 exchange. Very clearly, after the guidance came out in 2019, and with TICJA, which is the Tax Cuts and Jobs Act of that happened right at the end of 2017, there's no like-kind exchanges for cryptocurrency assets. Okay, so that is slightly problematic because a lot of people took those positions prior to 2018. Honestly, there was no guidance, so there wasn't a lot of reason not to take those positions, but it's pretty clear after the fact that there's no concept of like-kind exchanges. There was a specific example actually that said if you were to convert Bitcoin to Litecoin, it's not eligible for a like-kind exchange. So kind of a way to go through that process. It was very, very interesting. The other piece is with hard forks. Pre the new guidance that we got, hard forks weren't really contemplated. So remember back when Bitcoin created Bitcoin Cash, a lot of people were like, okay, is that like equivalent to a stock split? How is that actually going to be considered taxed? So in the new guidance that we received, we know now that with a hard fork, the taxable event occurs as of the split at the fair market value on the date that it was split, or that you received the new quote unquote units, we'll say. And those new units would be valued on that day. With Bitcoin Cash, if you remember, if you were on Coinbase, for example, you didn't actually get your Bitcoin Cash until they supported it months later, right? So did you really get it when it split, or did you get it months later? So there's still, again, some unknowns with the IRS because they don't conceptually, I think some of them do actually, I shouldn't say that. A lot of them really understand the concept of how everything works and the complexity of all of this, but it's really hard for them to create guidance on this. And, I have every sympathy in the world for them, but it leaves a lot of, vagueness to the whole process. So I'm going to go through a little bit of some, I'll call them unresolved issues. So the first one I want to just touch on briefly is with foreign reporting. If you, again, remember back to when Binance allowed US investors on the foreign platform, that would be considered a foreign account most of the time and would require disclosure if it was over $10,000. But it isn't entirely clear because it's not technically a financial institution. So is it really a foreign account or not? In my practice, I've erred on the side of caution. Anyone that has a foreign account with respect to cryptocurrency assets, I disclose it. There's no reason not to. It doesn't cause any problems. So if you've got a foreign located jurisdiction for any of your exchanges or wallets or whatever, I would include that on your foreign bank account filings. The other kind of couple of areas is valuations. We talked about valuations a little bit already of like, how do we actually value something when we don't necessarily know when we received it? Like, what value do we use? Or maybe it's a situation where it's a token in a game, or it's something that you receive that there's not really a readily available market value. How do you value that? So there's a lot of valuation questions as a result of this. And then with wash sales, if you know much about how wash sales work in the stock concept, if you were to sell something for a loss and then repurchase it within 30 days, you wouldn't be able to deduct your loss. The loss would be washed out essentially, and it would just kind of, your basis would carry over and you would go on reporting using that new, or the same kind of basis you had before. Well, technically, we're not a security here in this world of cryptocurrency. So we don't have wash sale rules, theoretically. So it was not really contemplated, I don't think, as part of the original guidance. So it hasn't been part of anything that's come out. But that, in theory, means that you could harvest losses at the very end of a calendar year, for example, buy them back the next day, and you'd get a whole bunch of tax deductions potentially. Assuming you have lost crypto, which who knows, at the end of this year, maybe nobody does, I don't know. So it's just something to kind of think about with how you account for your transactions at the end of the years. And then the last one on that is record keeping. So record keeping is a challenge. When you transfer one cryptocurrency from, let's say you transfer from Coinbase to Binance, and then you put it into cold storage. Well, all of those transfers have to be tracked. And if you do it in different increments, then the software that helps people with this kind of thing gets confused and makes it difficult to track when you bought something, what the original cost of that was, when you actually sold it, do we have cost basis? I just went through a huge exercise with a client that had, I don't know, dozens of missing cost basis, and they only started trading in 2020. So we're not talking like years of transactions and or anything. We're talking about 6 months of transactions, and the software all the softwares are still struggling with that connection piece. They're getting better. That's for sure, but they are somewhat limited in that they only have certain exchanges with API connections, and they don't as easily track amongst multiple exchanges. Some of them are better than others, though. The piece with record keeping is you kind of just do the best you can and know that you have to continually keep records. So if you are going through the process of transferring from, one exchange to another exchange, and you're not 100% sure if anything actually came through, maybe run your API connection through the tax software real quick and make sure it worked, right? If that works, then you're good to go. You don't need to worry about it. You can do it in real time. If it doesn't work, then hey, I need to manually make this work, and you'll be in the moment, which I realize is not super easy to do for people that have hundreds or thousands of transactions on a daily basis, right? So it is a bit of a challenge for people that do a lot of trading, I would say. Okay. So the other unresolved issue that we have, round 2, I'll say, and it's only 1 year later, right? So we have a little bit more guidance and also more questions. In the last year, I'll say, more than a year at this point, but time flies. We have a couple of other things now that, again, the information we got from the IRS doesn't necessarily contemplate. Staking rewards is one of them. So with staking rewards, we don't really have a lot of information about what the IRS thinks about that. But we can glean from the fact that the IRS considers what cryptocurrency is as property, that the income generated from property is taxable. Okay, so if you're staking your Ethereum right now, for example, or Tezos, or any of the ones that you can stake, right? And you're getting 1 Ethereum a month off of that. Well, that's probably considered ordinary income, very likely, and it's considered taxable at the time of the receipt. So that's something to keep in mind, because a lot of people don't realize that those staking rewards are going to be considered taxable. If you have a reward that comes in at, say, Ethereum at $3,500 or almost $4,000 today, I think, then you have $4,000 of taxable income. that you may not have cash to the side if you don't actually take the, anything out to cover those taxes. So I think it's going to start to become a situation where the staking rewards can produce pretty sizable tax implications, especially with Ethereum, just because the value is so much higher on a per unit basis. I see a couple of questions in here. So one note is, Coinbase does have a link directly to TurboTax. I will caveat, because this is actually one of them I was working with Coinbase on, or working in Coinbase's information. They were the ones struggling with tracking some of the basis information. So while it links to TurboTax, you need to verify that your cost basis is reported. Because if it says 0, and you didn't pay nothing for what you sold, then there's some digging that needs to occur to make sure that you've got the right cost basis. For mining that is subject to SE taxes, you are correct. You should be filing your, in theory, filing your tax payments on a quarterly basis, depending on how you pay your estimated taxes. But generally speaking, it's going to be on a quarterly tax basis. So I have actually never, the next question is, would TaxBit be better than TurboTax? I've not worked with TaxBit before, so I'm not familiar with the system. I honestly don't use TurboTax either, but that's just because, our systems are quite a bit more robust, I would say, than what like TurboTax is. But TurboTax is really good for helping walk you through things if you can answer like the questions and use the API integrations and all that kind of stuff. So it's definitely a good starting point, but you probably need to not assume, at least, that TurboTax or any other tax platform, for example, would actually be able to provide the exactly perfect information. Perfect. Yeah, if TaxBit is going to join, that'd be awesome, because then you can kind of ask them these kind of questions of how do you deal with these issues that are coming up. So the other kind of 3 areas of unresolved tax compliances are related to NFTs, the usage of tokens and earning of tokens. So, for example, when the first or the second set of guidance came out, they had indicated that tokens earned during a game that were specific to that game had value, and you'd be taxed on it during a game. So the IRS came out subsequently and said, okay, that's not exactly what we meant, but there's still a lot of grayness to this stuff, because if you think about it, and I'm not a big gamer, so excuse my lack of knowledge here, but if I am in a particular game and I get tokens that I can use, either cash or tokens, to buy things during the game, then didn't I just get value that I've converted into a new set of value? I would think so, because I could have used cash instead of the tokens I earned, right? That seems to me that there is some value there. How you would value that, I have no idea. That would be something that would be really cumbersome, I think, to try and sort through.
And
I'm a bit confused by what you mean. Are you talking things that directly you get cryptocurrency tokens directly, or are you talking about in-game currency?
In-game currency.
Because I am a big gamer, and certain games we get rewards in-game currency.
Yep. But
I can't use it for anything other than purchasing things in-game.
Yeah, which is why the IRS clarified after that that's not, like they didn't think that was actually as taxable as they thought. So you would want to verify that. But my expectation is that in-game currency that's not transferable or tradable, keep in mind, you can't trade it for cash. Like if you can trade your in-game currency to another player for cash, then potentially you do have a taxable transaction, right?
I can gift currency to other players.
Yeah, so I would say you probably want to look at that to be.
But there are. I don't play these games, but I am aware there are games that do give you rewards in actual cryptocurrency.
Okay, in actual cryptocurrency is a whole different ballgame.
Well, I think it's a unique situation in that you can't cash it out. It's strictly like an in-game wallet. You can only use it in-game. But
Yeah.
it is. But from what I understand, it's actual real crypto.
Huh. Okay, I'd have to probably know more.
I'd have to do more research myself.
Yeah, that's very interesting because
it's a very new type of online game.
Wouldn't surprise me. Something new came up, right?
Yeah.
Exactly the issue I think the IRS is having, which is why they came out with that saying, okay, it is taxable. And then everyone said, how on earth would we value something that's in game, that's only usable in that game and nowhere else, right? There's no readily available market value for those things. So that's where I think we'll have to, I would say for that example, that is something else I think that may be up and new, and we'd have to kind of look at individually on their own facts. But again, all of this stuff is exactly what I'm kind of talking about as far as like, there's so many things that are changing so fast that what was the answer before is not going to be the same if the facts have changed. And it's really hard to see the distinction on when the facts are changing versus what the original fact pattern was when the IRS gave the guidance.
I think like maybe Axie Infinity SLP might apply because it's token.
In game is, yeah, exactly. If there's a value, if I think there's a value outside of the game, then the IRS is going to consider that to have a value. If it's got a market value outside of the game, I think that will be a taxable event. But I don't know that any of the gaming softwares are providing, here's your 1099 with the value of what you've received. I doubt that, in fact. So that's something that will probably, again, evolve over time as the guidance gets clearer in those areas. All right. This is exactly on par with what we were just talking about. The pace of change in crypto and blockchain is so fast that what the guidance was a year ago is almost already out of date based on how the games have evolved or how the space is evolving. The things that we will see, I think, in not necessarily more detail, but the things we're going to see, I think, more often are ways that cryptocurrency can start empowering unbanked individuals, right? We already know that it does that in cases like Venezuela, for example, that has such a mess of currency at the moment that this is could be huge for them. For other countries in Africa, having jurisdictional commerce can be a huge savings for them, and there's a lot of ability to do that already. And I think that's just going to continue to evolve and expand the space. The amount of transactions that are not investor transactions in Bitcoin in particular is growing every year for these types of use cases. And I think that will continue to evolve, and we'll see more of that, as also, I think, also more lending. We've already seen companies that are using cryptocurrency. Like if you have cryptocurrency and you want to get a loan, your traditional bank will say no. So for the most part. So you'll have to go to these alternative banks that all do all these kind of lending based off of your cryptocurrency holdings. It's kind of interesting to see. I think Schwab might have actually created another platform that focuses specifically on cryptocurrency. I don't know if it's Schwab or JP Morgan. I can't remember which it is that actually backs it, but there's a big bank backer that is actually looking at exactly these types of things to be able to provide, because they can see the writing on the wall as far as where cryptocurrency will take the future of banking. And I think that not only in the cryptocurrency space, but just in blockchain in general, we'll be able to see more use cases over the next year, 18 months in supply chain management, personal identity security, energy, real estate, all these different areas that can really substantially benefit from just the concept of blockchain. Again, not necessarily cryptocurrency related, but the conceptual platform and the development of the blockchain. So from a state tax perspective, you know, there's a couple of things to keep in mind from an entity perspective, whether or not you have the understanding with the state of, and if it's miner management that's governing where the activities are going to be taxed, or if it's the location of the mining software, or not software, mining equipment. And that will tell you kind of how to allocate a portion income and, you know, what your tax base is based on. You also have to be careful that in some states, using cryptocurrency, if it's subject, for example, to any sort of business and occupation tax for Washington, or sales and use taxes, or new capital gains taxes. In Washington, as an individual, starting on 1/1/2022, we will have a Washington state capital gains tax for any gains over $250,000. And it's, I think 7% is the amount. Now, whether or not this sticks is a whole different conversation, probably. Historically, this income or this capital gains tax has come and gone on a couple of different fronts, mainly because Washington state actually says in our constitution that we cannot have an income tax. So theoretically, we can't have an income tax. The arguments historically have been that, you know, capital gains taxes aren't income taxes. This new version of that same argument probably is the most viable argument that will stand up because of the way they're approaching the calculation of the tax and the imposition of the tax as well. So we'll see. I'm sure there's at least a handful of lawsuits that are trying to get rid of this at the current moment in time, but I don't know if they will actually succeed in this instance. So at a minimum, plan ahead that January 1st, 2022, it'll be a 7% tax on top of your federal tax rate. Okay. All right, so that's all I have as far as slides. So hopefully 15 minutes is what I tried to leave for questions. Does anyone have any questions they want to start out with?
I have one I just posted.
What was that? Let me just see.
If I use my cryptocurrency card to purchase anything, am I charged sales tax at the time of purchase? Am I still subject to additional taxes?
Yeah, so great question. So let's use an example. If I take Ethereum, for example, and I decide to buy a Lamborghini because I know Lamborghini takes Ethereum, I will pay tax on the exchange of my Ethereum for the Lamborghini because I'm changing one form of property for another. So if I purchased that Ethereum for $10,000 and it's worth, you know, whatever, 300, I don't know what it would be now, but $300,000, let's say, I bought my Lamborghini for $300,000, I would pay tax on $290,000 of capital gains. The sales tax wouldn't necessarily apply to the sale of the asset, at least not in Washington State's case, but it would apply to the purchase of the car. Does that answer your question?
Sort of.
Okay.
I was recently in Europe and I could have used my card because there are a lot of places in Europe that you can use cards that are crypto based, but I actually avoided doing it because I wasn't sure what tax exposure I was opening myself up to.
Well, and that is an issue with all the cards that are out, because in my experience, the card companies themselves, which let's say you transfer a Bitcoin in there and you can use the Bitcoin to pay for products or services using your card. The issue you have is every time you use the card to pay for something, there's a capital gain or loss on the use of that cryptocurrency to buy something.
Exactly.
And the card companies, at least so far, have not provided us sufficient information to be able to track and capture or import into these tax reporting softwares that level of detail. So it is getting to the point where I'm kind of surprised, to be honest, at some of the ones that I've seen, that like the reports out are very limited as far as the information. And maybe it's just my clients don't necessarily know how to pull the information, and I'll need to dig in myself to see if we can sort that issue. But it is a bit of an issue, I think, on a lot of the different card-based cryptocurrency companies.
Interesting.
I just looked at my card. The interesting thing is it's a Visa debit card.
Yep.
Yeah.
Mm-hmm.
I don't know what they're. It's. I would think they'd have more of a recognition of that they have to provide that information, or maybe there's some exception that they're using, but I'm not aware of one at the moment. So, yeah.
Next question, Roger, and then we'll go to George. So Roger's question: the crypto tax website I use only supports FIFO accounting when calculating gains. Not super well versed with the tax lot IDs and other methods. Wondering if you've seen consumer websites, products out there for tax lot ID, etc., for cryptocurrency.
Yeah, there are a couple of different platforms out there that do use multiple, or that you can use multiple versions of ordering, I'll say, and specific identification in particular. If you want to check out Legible by Verity, that's one that I've used quite a few times. They're also part of the AICPA Blockchain Symposium group. And I think Luca is also one that does that. I'm not 100% sure on that one. I haven't used it myself. So yeah, I'll send let me pull it up and see if I can.
Yeah, can you write the links or names into the chat, please?
Yep.
And then next up in questions, we have George Hervey.
Hi. So I actually wanted to jump back to the Visa cards with cryptocurrency again. Mm-hmm. So I know with a lot of the debit cards, they allow you to pay with your cryptocurrency, but I know they also have Visa credit cards where essentially you're just paying like credit, fiat money, but you could get cash back in Bitcoin, for example, like BlockFi. Mm-hmm. Would that categorize as like an airdrop and lead to any kind of tax regulations?
That's a good question. So if you think about it, right? Let's say you have a Capital One Visa card and you can use your Capital One travel rewards card to you can offset your travel purchases, right? You don't get a 1099 from Capital One saying, here's your income that you received from the discount that you essentially got. The catch is if you're not using it in their own platform to offset your own transactions, I'm wondering if you receive it into another account, if that would cause it to become taxable. I don't know. I need to look into that further actually and see if that would be considered taxable, because theoretically we already do that with fiat currency, right? So the fact that it's property versus fiat shouldn't theoretically make any difference. I would say yes, if the earnings are less than 600, there's no 1099 needed. But there's lots of businesses out there that I work with that don't get 1099s for way over $600 in cash back and those kinds of things. So not sure if I think there's a different exemption that's being applied in that instance, I think.
Interesting.
Okay. Thank you.
Yeah.
Cool. Scott, next.
Okay, bear with me. I'm not quite sure how to ask this question. It has to do with the recent decision. I'm not sure which governing body, it might have been the IRS, but to make basically anybody that is a cryptocurrency investor a broker status. I
don't think it was the IRS. Definitely not actually the IRS.
Do you know who that was, Ari?
That was the U.S. Treasury Department trying to put
Treasury.
that through in the recent infrastructure bill. We've had a lot of lobbying happen on both the Senate and House side from the blockchain and crypto associations across the U.S. and also by states. Yeah. So right now, it's likely that there will be an amendment, whether it's actually through this current infrastructure bill or at the end of the year when they do these tax fixes where they put an amendment through that'll get fixed. That'll definitely get fixed in one way or another. So TBD on that. Just stay tuned, and we'll post notes as soon as we get more updates too. But also follow the Blockchain Association. They've been really, really active on the lobbying front on that.
Mm-hmm.
Okay, because I'm very curious how that is going to affect our tax footprint.
Mm-hmm.
Based on, because now they're saying, the Treasury is saying, I'm no longer an individual investor. Now I'm a broker. I'm like, wait a minute.
Yeah.
I'm not a broker.
Right. Yeah. I feel like they'd have a hard time. The IRS in particular would have a very hard time arguing that because of the fact that they have a very clear definition of what a broker is for like securities and such. Right. For specifically for tax purposes, that is very different than it would be for like Treasury or SEC reporting purposes or anything like that. So seems like we would probably still follow those same IRS rules, but I honestly will have to see the language of the bill, which I don't believe is even available. It's a very rough framework right now that is not actually clear on language.
Yeah, we have the latest copy that's in the House right now, but we'll see what actually happens.
Exactly.
Hey, Roger, next question.
Yeah, I think I just had a question if I missed something. So there's mention of a Washington capital gains tax next year. Is that for businesses only, or is that?
Individuals, actually, yeah. So right now, the primary exemption from capital gains tax for Washington state purposes would be real estate.
So that starts January 1st?
2022, at the moment.
Oh.
Yeah, not cool. I mean, from a personal, like I don't want to pay tax on my crypto gains. So, but I mean, it doesn't start till $250,000, right? So, I mean, theoretically, if you sell less than that, then it doesn't apply. It's only for gains over the $250,000.
This is why I'm moving to Delaware.
Honestly, I've had clients already buy houses in Texas in response to this. So it's entirely possible we will see a, migration.
Yeah. Carlos Tepang, next question.
Thank you. So when I deal with DeFi, all I have is just the crypto address, right? My crypto address. Now, I also have a company. And sometimes I want to attribute the transaction to my company, sometimes personally to me. Is that going to be a problem? Also, there are exchanges actually that are difficult. Where it's difficult to register as a company, but easier as an individual. So I registered as an individual, but I want to attribute my transactions in that exchange to the corporation.
Yeah.
Is that possible?
Your record keeping needs to be spot on in order for that to happen. It's really difficult because the IRS assumes it's all yours, right? So you need to have good, clear documentation that you are just the facilitator of that transaction and you are holding it on behalf of and all of that. So you want to have all the necessary legal documentation in place, all of the tracking in place to be able to do that. Otherwise, you could run into issues with the IRS trying to make it so that it's your transactions versus the businesses. So
I do take notes. So maybe I should just.
If I can interject, you need to really be careful about commingling.
Yep.
Oh.
Yeah.
Very careful. Yeah, you better be super, super, super detailed documenting right now.
Yeah, and I don't know, does anyone have at this point in time, so Coinbase, for example, and there's not really a lot you can do on Coinbase as far as getting a hold of somebody. We have issues with estates and trusts all the time at this point because, can't create an estate thing. Yeah, Coinbase support is horrible. Touche. So I don't know if anyone else has a particular platform that they would recommend as far as being able to have more flexibility or more support.
All the crypto companies have really challenging operational issues. It's kind of, they're growing really fast.
Yeah.
My recommendation to Carlos is set up maybe 2 separate personal accounts within, if you're Coinbase or whatever platform you're using. And then you have 2 personal accounts that you're using, but, track it as, this is personal for facilitating company stuff, and this is my personal, and just move it between the 2. And then
keep everything separate.
Yeah.
And have the company use fiat to pay you back for the transaction. Write checks to yourself. Like, be very, very, very diligent about that.
Oh, wow. Okay.
And if you haven't, you got a lot of cleanup to do.
Yeah.
Yeah. Yeah, actually, that's probably the most difficult part. But actually, I have somebody in the Philippines who's doing that for me. Sorting out everything. It's a lot of work, a lot of detail. Yeah.
Yeah. Well, and tracking. If the software doesn't, tax reporting software that you import everything into doesn't do a great job of tracking, which not all of them do. It takes a lot of your own legwork, and it's really even hard for like your CPA to come in and do it. We don't know what happened with the transactions or where they came from. So we can do to some extent, I can say, okay, I can clearly see that went there and that went here. But, whether or not I'm going to be better than your API integration is probably unlikely. So
can I do it where, I have that person in the Philippines doing kind of the bookkeeping, for all the transactions, and then submit it to, let's say, to you to examine it, whether it's good or not, and then we can go from there.
Yeah, that's something you'd want to work with your CPA on what they can do to help kind of track all of that. Yeah.
But also expect to put in a lot of your oin time on the front end or on the other end. There's no way out of it. I've been through it many times. No way out of it. You still have to put in time. Yeah. So we have basically 1 minute left. Jennifer, thank you so much for your presentation.
Thank you. Yes, thank you.
Super helpful. If people want to get in touch with you or follow you, what's the best way to do it?
I'll give you a copy of my slides so that you can post, and I'll have my contact information in the slides. So.
Okay, great.
All right.
Thanks, Jennifer.
Yeah. All right.
I'll
again.
Take the recording and also post it and share once it's ready for everybody.
Okay. Excellent.
Nice Battlestar Galactica background, by the way, Arry.
Yes, I love Battlestar. All right, everyone. See you next week. Next week we have who do we have? We have Whit Gibbs from Compass Mining. So if you're into mining and want to learn how to be a miner without the mining gear, next week it's it.
Perfect. All right. Bye-bye.
Bye.
Thanks for tuning in. This podcast is non-technical, fun, informative way to learn about money, Bitcoin, blockchains, crypto, and digital assets. This podcast is not financial advice, and your reactions are your total and complete responsibility, y'all. Now, thanks again, and enjoy the show.
What are you doing?
Stuck inside.